Welcome back, everyone, to Money and Markets. Many experts say the Federal Reserve's policy of quantitative easing is intended to debase the value of the U.S. dollar. Even if that's not the Fed's explicit goal, the dollar has been trending lower, and it will probably continue to do so after next week's central bank meeting, at which another round of QE is pretty much a foregone conclusion. But what you need to know is how to take advantage of that trend. And joining us with some suggestions is our producer, Jen Amos. Good to see you, Jen.
Good to see you, Jamie.
Jen, you asked all of the Weiss research editors their take on how to play out these currency wars, and what did they tell you?
Well, it's a good bet that the dollar will continue to fall in the short term. So the logical play would be an investment that has an inverse relationship to the U.S. currency. Our editors gave us a couple examples of these. ETF expert Ron Rowland picked the PowerShares DB US Dollar Index Bearish Fund, ticker symbol UDN. It holds a basket of 6 different currencies that usually go up when the dollar goes down. And you can see from its performance over the past few months that it's done just that. A similar play is the Federated Prudent Dollar Bear Fund. It's a mutual fund, not an ETF, and it hedges exposure to the dollar in a different way, with fixed income securities rather than other currencies. Mike Larson has been recommending it in his Safe Money report and recently took profits on it because of a strong recent run-up. But he still thinks it's a solid play to benefit from a falling dollar and rising gold prices.
Okay, Jen, so what would be the opposite side of that trade?
It would be the funds that move in a direct relationship to the dollar. Both Ron and Tony Sagami are panning the PowerShares DB US Dollar Index Bullish Fund, ticker symbol UUP. If you think the government's policies are going to continue to have a negative effect on the dollar, you're going to want to stay away from this one.
Jen, it seems like the policies that the U.S. and other countries have in place are likely to keep the dollar low and the yen high. But Brian Rich suggested a solution that would reverse that trend. What if that actually happened?
Yeah, he's suggesting a coordinated intervention in the currency markets by the U.S., Europe, Great Britain, and Japan. That would weaken the yen against the dollar and weaken most other global currencies against the Chinese yuan. And it would end the need for the type of competitive currency devaluations we've seen from Thailand and Brazil, just to name 2 examples. If this does happen, the yen would start to sink. So Brian would recommend the ProShares Ultra Short Yen ETF, ticker symbol YCS. And his pan would be the Currency Shares Japanese Yen Trust, ticker symbol FXY. Unfortunately, Brian points out that this strategy does have one drawback. It would not solve the biggest problem in the currency markets, the Chinese currency's undervalued relationship to the U.S. dollar.
Okay, Jen Amos, thanks so much for your time.
Thank you, Jamie.
Coming up next, Brian Rich will be back with us to discuss his forecast for the currency markets with Chuck Butler, the president of Everbank World Markets. And a bit later, a closing comment from Martin Weiss, all that in a moment.